Welcome back. Today on the Byte-Size Brief, we're going deep on Spotify, ticker symbol SPOT. We're looking at a genuinely fascinating moment for the streaming giant right now. It's a moment defined by massive leadership transitions, core tech shifts, and their ultimate ongoing path to profitability. We're going to unpack their recent performance, dig into their strategic shifts, and really look at the underlying mechanics of their platform. Let's see exactly why this company demands your attention right now.
So here's the fundamental paradox we need to unpack today. Despite a massive Q1 earnings beat and reaching an incredible 761 million active users globally, Spotify's shares recently gapped down. They dropped from $495 all the way to $445. That's a 14% drop year-to-date in 2026, and it's left a lot of investors scratching their heads. You have to ask why. If their profits are literally breaking historical records, why on earth is Wall Street punishing the stock? Well, the answer really lies in the forward-looking nature of markets, where future guidance almost always eclipses past performance.
To understand this disconnect, our explainer today is going to walk through exactly how their business works, the reality of their latest quarter, the competing market narratives in our bull versus bear case, and finally, what the future roadmap looks like for the rest of 2026.
Let's jump right into Section 1, Business Model Deep Dive.
Okay, we need to look at how this company actually makes its money. Because, let's be honest, if you don't understand the plumbing of Spotify's business, you simply cannot understand their current valuation. I like to use a freemium funnel digital landlord analogy here. They basically operate a dual revenue stream. You've got the free ad-supported tier, which makes up about 9% of their revenue, bringing in somewhere around 385 million euros. Now, technically, that free tier operates at a loss, or at least a near loss. But you have to think of it as a massive global billboard. It's an enormous top-of-funnel acquisition tool. The entire goal there is just to pull listeners in, let them experience the ecosystem, introduce a bit of ad fatigue and skip limits, and then eventually convert them into rent-paying tenants on the premium tier. That premium tier, that's the real economic engine. It drives a staggering 91% of their revenue, translating to over 4.1 billion euros last quarter alone.
The absolutely crucial health metric to watch here is their ARPU, or average revenue per user, basically how much cash they make on average from each individual premium subscriber. Spotify's ARPU recently hit €4.76. To put that into perspective, for years, critics were arguing that streaming was just a race to the bottom, right? They said users would never accept price increases, especially in a highly inflationary environment. But this number, this 476 figure, really proves their pricing power. They executed a critical U.S. price hike to $12.99 a month, and instead of a mass exodus to competitors, users just stayed. It really shows how deeply habituated people are to their specific playlists and algorithms, and that allows Spotify to effectively monetize their tenant base across over 180 different markets.
Ultimately, this sheer scale, we're talking over 760 million users, forms their economic moat. And let me tell you, they desperately need that moat. In the music streaming business, you don't actually own the product. You're essentially just renting catalogs from a powerful oligopoly, the big three record labels, which are Universal, Sony, and Warner. Because these labels control the vast majority of popular music, they get to dictate the terms. So, Spotify's massive global footprint is literally their only true weapon here. It gives them the leverage they absolutely need to negotiate better per-stream licensing costs. As their user base grows to a size where the labels simply cannot afford to ignore them, their per-stream costs theoretically go down relative to their revenue. That gives them a major structural advantage over smaller, localized competitors. All right, moving on to Section 2. What changed last quarter? Let's see exactly how that business model translated into their Q1 2026 earnings report, because the numbers here are genuinely striking. Just take a look at these massive year-over-year leaps across the board. Revenue is up 14% on a constant currency basis, hitting 4.53 billion euros. Active users jumped 12%, but the real star of the show? It's that middle line. Look at that incredible transition from 225 million to 721 million euros in net income. That is a breathtaking 220% increase. Their adjusted earnings per share came in at $4.04, completely crushing Wall Street's estimates. They are undeniably proving that their transition from a startup mentality to a highly profitable enterprise is fully underway.
But honestly, the absolute standout metric of the entire quarter is this record gross margin of 33%. This is perhaps the biggest win for the company. For years, the fundamental knock on Spotify was that they couldn't squeeze a sustainable profit out of those heavy music licensing fees they pay to the labels. Hitting a 33% gross margin, That shows that the recent price hikes, coupled with some really severe operational efficiencies and layoffs they executed last year, are finally outpacing those core costs. I mean, they generated 824 million euros in free cash flow in just 3 months. That's huge.
But as we noted at the very beginning of this explainer, the market still mercilessly punished the stock. So what gives? Well, it all came down to management's Q2 guidance. They forecasted lower than expected operating income of 630 million euros. And that signaled to investors that growth in highly saturated markets like North America and Europe is starting to slow down. They also flagged a pretty troubling softness in the ad-supported revenue segment, which only grew 3% year-over-year. And perhaps most concerning for retail investors, top executives, including the incoming co-CEOs, recently sold over $12.5 million in stock with absolutely zero insider buys. When the people running the company are quietly taking chips off the table during a record quarter, well, Wall Street understandably gets a bit spooked.
This brings us right into Section 3, the bull versus bear case.
So, we have this undeniable earnings beat, completely overshadowed by highly cautious forward guidance. How do we weigh these mixed signals? Let's break down the bull versus bear case. The bull case focuses heavily on 9 consecutive quarters of premium subscriber growth, reaching a massive 293 million paying users. Plus, their non-music bets are actually paying off. For example, UK publisher Bloomsbury reported audio sales grew 57%, and that was largely driven by Spotify integration. On the flip side, the bear case zeroes in on that weak Q2 guidance, rising user friction, and most importantly, the looming risk of massive 2026 record label contract renewals. Let's walk through why this is so critical. If the big 3 labels look at Spotify's shiny new 33% gross margins and decide, hey, we want a larger piece of the pie during renegotiations this year, it could be devastating. Even a demand for just a 1 or 2% increase in royalty payouts would instantly compress Spotify's margins. It would effectively wipe out the operational gains they'd just spent 2 years bleeding for. The labels ultimately hold the keys to the product, and that structural vulnerability is the absolute cornerstone of the bear thesis.
On the bullish side of things, management is projecting some intense confidence. Incoming co-CEO Alex Nordstrom's remarks basically signal that Spotify has effectively completed its evolution. They aren't operating with that frantic, growth-at-all-costs tech startup mindset anymore. They genuinely consider themselves a mature, sustainable, and profitable scaling machine. They're generating massive free cash flow, buying back shares, and retiring debt. These are all classic, fundamentally sound signs of a maturing business that has finally figured out its unit economics.
But we kind of have to juxtapose that glossy corporate optimism with the raw reality on the ground. Longtime users are getting incredibly vocal about their frustrations. If you look across music forums, you see complaints exactly like this one. My Discover Weekly no longer slaps, and my daily mixes are all the same stuff. And shitification hits Spotify pretty hard. Users are feeling a deep sense of algorithm decay. They feel like they're being served the same 200 songs on an endless loop, and they sense that the platform is prioritizing paid label placements or sponsored content over genuine organic music discovery. And when your core brand promise to the consumer for an entire decade has been seamless discovery, widespread user fatigue is a very serious, fundamental threat to long-term retention.
So how are they handling this? Well, to combat this specific fatigue and that ad market softness we mentioned earlier, Spotify is aggressively diversifying away from purely relying on the music algorithm. They recently secured a massive global partnership with Peloton to integrate over 1,400 fitness classes directly into the app. They're also pushing video podcasts incredibly hard, and it's working. They're seeing a 54% year-over-year jump in engagement with over 39 million users streaming video. Plus, their audiobook catalog has just exploded to over 500,000 titles. But all of this raises a vital question. Are video podcasts, fitness classes, and audiobooks really enough to keep a user who originally signed up and pays a premium purely for music discovery? Let's wrap things up with Section 4, the future roadmap.
As we close out this explainer, let's look beyond Q2 2026. What are the next key events and product launches you need to watch to see if Spotify can actually maintain its dominance? Well, 2026 is a year of massive transition for them. Founder Daniel Ek is stepping back to become executive chairman at the end of the year, handing the CEO reins fully over to Alex Nordstrom and Gustav Soderstrom. Over on the product front, to directly address those loud user complaints about algorithm decay, they are rolling out a new AI-powered taste profile beta. This is huge because it will finally give users transparent control to literally edit their algorithm, dialing back certain vibes, removing outlier genres, or boosting specific moods. If they execute this well, it could completely revitalize user engagement and fix their biggest product vulnerability.
But there's a major looming question for the back half of the year, and that's the long-delayed Spotify Music Pro tier. This is their much-rumored lossless, high-fidelity audio add-on. The multi-billion-dollar question here is whether users will really fork over a $5 to $10 premium for better sound quality and some advanced AI mixing tools. This is a massive headwind. Why? Because formidable competitors like Apple Music and Amazon Music already include lossless audio in their standard base subscriptions for free. Remember, Apple and Amazon treat music as a loss leader just to sell iPhones and Prime memberships. Spotify doesn't have that luxury. Music is their entire business, and they have to make a margin on it, which makes it incredibly difficult for them to compete on price for premium audio features. And honestly, that is the ultimate test for Spotify moving forward. Can their new AI features and content formats truly outpace their rising subscription costs? That wraps up today's deep dive explainer on Spotify, ticker SPOT. For a sharper, more candid discussion, join us on the full audio explainer. And definitely drop your questions and hot takes in the comments. We read every single one. Thanks for tuning in, and we'll catch you next time.